I will come to New York.
Could everybody mute their mics? Come on, that'd be awesome.
Yeah, so if everybody mutes their mics for now, and then we'll get moving. Or I can do it. Okay, there we go. Right, let's get moving. So, core trading strategy. Trading with the trend. It isn't rocket science. You don't have to have a degree in mathematics or engineering like I do. You really just need to understand the behavior. And that's what we're going to talk a lot about this weekend. It's all about behavior, using the indicator suites that we've developed to actually understand that behavior, but more broadly to really understand, looking at support resistance zones, non-linear support and resistance zones with those channels and that sort of thing, really. So, you know, this strategy is simple and repeatable, and more importantly, if a trader sticks to it, okay, and that's the main thing. You need to stick to the rules. With strong discipline, it yields consistent profits in any trading business. So whether it's part-time, full-time, whether you're a trader or an investor, I still use the same strategy, okay? And sometimes that strategy seems a little slow, but all of a sudden you've got to make hay when the sun shines. And you know, so everything I talk about in this webinar is equal for futures, stocks, or ETFs, okay? Now, I found that the truest time frame out there for stocks, for example, when you're swing trading, is that daily time frame, because we have the open, the close, the high, and the low. And then when you put all those candles together, that's the true trend, the true picture of what's happening in that particular stock. So, you know, when we are talking day trading, it's a little bit different. If you're day trading futures, you know, 3, 2, 5 minute, 15 minute, you've got to see what's in the groove for the day, or it could be flat for the day. But when you're swing trading stocks, that daily time frame, and it's a good picture. So when you look at Apple really reflects how the S&P is doing, for example. So, you know, on a lot of 80% of the time, if Apple's moving strong up, so is the S&P. So they're a good guide on putting those daily candles together for that. So let's move forward. Remember, you're all adults. You're all traders with your own brains. So everything I say here for educational purposes, okay? There is risk with trading. You could lose everything you own and more. So just be very cautious and look to manage that risk accordingly. So what is a trend? It's simply herd mentality. Now this is a reaction to a cough or a sneeze in a store at the moment, okay? If somebody's not got a mask on and they cough or sneeze, this is what happens, that herd mentality. So remember, I will be talking about herd mentality in the context of any time frame, okay? So this is the official description of herd mentality, is a behavior in which people act the same way or adopt similar behaviors as the people around them, and often ignoring their own feelings in the process. And this is it's a prime example of what happens in the markets. So trend behavior, you've probably had a parent or teacher ask you, if your friends jumped off a cliff, would you do that too? Of course not. You know, it's insane. You're a strong and independent free thinker. Why would you do that? So why do you follow some people into these trades and things like that? So actually some people do fall off and jump off cliffs and follow other people. But what if your friends were jumping? Sorry, I'm going to keep you on mute. We'll do the questions after the lesson, Matt, because I really can't hear you. Can you put it in the chat? But you know, if your friends weren't jumping off a cliff, Instead, what if they were buying shares in the latest tech stock, Shopify, for example, okay? Every day you see the price going up a little. Your friends are talking about it, how great the tech company is. You know, after a while, it's not so much a question if you're going to buy those shares, it's when you're going to buy that shares. And that's how that herd mentality starts to kick in, if you like. So this is it's a simple view of trend behavior. And we'll be delving deeper into this during the weekend. And, you know, believe it or not, it happens more often than not in the trading and investing world. So how does this help with a trading strategy, you may ask? So reality is that our friends buying stocks, you know, it isn't going to move the price as retail traders. However, the same herd mentality holds true for institutional traders because they are human beings after all, okay? Even the algos were programmed by human beings. So what you may ask, what is that, you know, how's that going to help us with trend behavior? So let's just talk about this in sections. We're going to talk about the bulls first, so we're going to look to go along. So when an institutional trader, so I'm going to tell you the story now of how majority of the time this is how things go and how things you know, momentum starts to build and then sell off and things like that. And this is understanding that behavior. So an institutional trader sees value in an instrument and buys a sizable amount of contracts or shares in that instrument. Other traders, institutional traders, start to take note. And after that similar analysis, because they all go to the same school, they all take the same exams, and they're doing similar analysis, they're all using the same sort of software that I use. You know, the software that we've developed is a dumbed down version of that, but it's affordable and it works extremely well. But they're all using the same thing. So they're doing that similar analysis. They start to buy, which makes the price start to move up. So as momentum grows and more traders don't want to be left out, that fear of loss, the price starts to trend up higher. So this doesn't last forever because, you know, as those human institutional traders who got in early want to start to take profit at some stage. So if, for example, we, on the inner circle, we got in around about $320 on Shopify. It's now at $630. There's people that got in that a lot earlier. They are starting to want to take some of those positions off, maybe start to take that profit. So, you know, you've got to think about their bonuses. Some institutions now have cut bonuses and give better salaries, but in the end of the day, the main driver is bonuses, whether it's quarterly or annually bonuses. So if you've got in 1 million shares on Shopify, for example, at $300 and it's now at $650, you know, you're going to make $300 million profit, yeah, if you sell them all. Why don't you take $100 million profit right now at the end of this quarter, got a great bonus, go and buy a new boat or something like that. That's that human mentality. You know, they can justify it by they're leaving $200 on the table, 200 million on the table. They've taken 100 million off. All their investors are happy, their bosses are happy, and they're getting a great bonus. There's a lot of things going off, and every institutional trader has their own, how can I put it, their own pressure points. Second mortgages, all that sort of thing. There's different things going on in their lives, but at the end of the day, they're human beings. So now for the bears. So when some of those early buyers start to take some of their positions off to take that profit, so do some other institutional traders. You know, he must know something. Somebody at that particular broker or bank knows something. I'm going to start to take a little bit off there. And that really is a bit of safety to cover any major sell-offs and to bank some profit. So at a certain price point, those traders that got in the herd move later on find themselves at a price lower than their original entry. So let's take, Shopify, for example. Got in at $300, went to $600. People started selling off. Now, people that got in at $450, once it starts coming below that, actually the price is lower than they got in. They waited for the pullback. It's gone lower than their original entry. And it's a critical time in that trend behavior now to see, do they hold? Do they sell? And that's how the bears start to gather momentum or not. So then we look at, and that's the pullback that's really, really important. So if those traders in a slight loss-making position still see strong growth potential in that instrument, they buy more contracts or shares at a lower price. This then lowers their average holding price. So they bought original at 450, goes down to 400. They buy some more at 400. Their average holding price is 425. So if it bounces up above 425, they've got an option to sell, get out, break even, or if it goes back up to $600, they're going to make more money. But it's this critical time on this pullback, and it's those traders that they're in a slight loss-making position. If they still see that growth potential, they're going to buy more contracts. So other traders see this bullish volume. If this happens and see this pullback as an opportunity to get back into that bull herd, if you like, and this is what that wave 4 pullback is. And again, I'm building the story up here to help you understand what's going off, why we then start to put those trades together. So what if we get a trend failure? That's the next thing. If those traders in a slight loss-making position start to panic when selling volume increases, they sell their positions to reduce the risk and take that little loss. So some of those early entry traders see this high bearish volume continue and decide to close the rest of their positions and take their remaining profit. But that increases that volume, that selling volume, and we get that trend failure. So lots more traders then sell and join that bear herd, and then you get the trend failure, okay? And to be honest, that actually is how it feels if you get stuck in a position. So we've just talked about how that trend behaves. So now let's look at it on a chart. So let's start with the range bound period down here on the left. Everybody can still hear me okay? I'm sitting a little back on my chair. Let's move my microphone. Just say in the chat if you can still hear me okay. Okay, brilliant. So I'm going to start off with this range period down at the bottom here. It doesn't matter what this is. It doesn't matter if it's a stock, an ETF, a futures contract. We've got a range bound period. So there's lower volume as well, okay? You can see this low average volume compared to this on the right. So, and then if we'd look left, we'd see that volume is quite low. So it's got low average volume. It's got a very tight range. So, you know, it's very small price action. There's not the shares or contracts swapping hands, going long, going short, but nothing's really going, there's no real volume. So then as we start to pick up with buying volume and price action starts to move up and we get our first impulse move. And that's what this is here, okay? So as you can see here, we get the price action going up. We also get the volume going up. So that momentum's going. So he knows something I don't know. I'm going to buy. He's buying, I'm buying. He's buying, I'm buying. So that's that herd mentality going there. So in the chat, can anybody tell me what this gap is? Okay, this is a stock. Okay, any ideas? Okay, I'll tell you. Earnings. Yeah, JW. So the catalyst with stocks, once you start to get that momentum going up and you get great earnings, you get the gap up and you get that big impetus of volume here down at the bottom. Let me just annotate that a little bit here. So you get this big volume spike here, okay, after the gap up. And it really does go for it here, okay? Really, really does go for it. Okay, then you get some profit taking. So this is that the story that I just told about the bears there, where people start to take profit. Okay, you can see how the volume starts to drop off on the pullback there. That's a good sign. Okay, so you know people are taking their profit at those highs, but the volume starts to peter off. The selling volume isn't really increasing there. Then I just want you to take note of this right now. Anybody tell me what that candlestick is? What do we call it? Anybody idea? Anybody idea? Any ideas? It's a hammer. But I want you to look at what the volume's like as well. So what happens is the stock or the whatever, the candle opens at this price here. This price there, okay? And then we go down, we reject the lows and closes here, okay? So it rejects those low prices on higher volume. You see how the volume's dropping down? And then at that pivot point, those traders that were in a slight loss-making position, remember what we just talked about there, in a slight loss-making position, still saw value in this growth, in this bullish trend. So they started to buy. And then those people that got in earlier here saw this pullback as another opportunity to add some more. So at that price point, when it hit down below, people liked it and started to buy more. That is a high volume rejection. Yeah, it's a hammer, it's a high volume rejection. The volume's higher and we get that rejection of those low prices. Okay. Then we get another impulse move up. You can see the average volume starts to increase. Very simple herd mentality. More people start to buy, especially when we go through this pivot here. Okay, let's just draw that in. When we go through this pivot here, you can see how the volume down below really starts to pick up there. Okay, all of a sudden, institutional traders see it beat that previous high and think this is going to go. This is going to run and buy it. More people start to buy, that herd mentality state takes over. There's more volume, there's more shares being bought. Everybody's getting excited. Those bulls are running faster and everybody wants to get in and pushes the price up really quickly. Then we get a longer profit-taking pullback. Excuse me. Okay, so we get a longer profit-taking pullback this time. It does pull back below this support and resistance zone here, but look at the volume. It's very key to understand. You've got to start, and we're going to be building on this during the weekend. You've got to understand the behavior in both price action and volume. This is important whether you're trading futures, stocks, ETFs. You need to understand both price action and volume. So more profit taking going off there. But then look, anybody tell me what this candlestick, two candlestick pattern is there? Okay, no, not quite, Matty. This is a bullish engulfing, okay? So we get this indecision red doji here. Okay, so this indecision red doji there is a sign. It is in high volume as well. So the buyers and the seller are in that day are equaling each other out. Nobody wants to push down, nobody wants to push up. The next day, the stock gaps down to here. Those people that bought going through here, for example, through this point here, it's actually lower than what they bought it for. What do they see? They see opportunity. They see reducing their average holding price. This is following a good bull herd pattern. So when it gaps down, what happens? They just start to buy, and it closes near the high and it engulfs this previous pattern, both on high volume, considering the volume drop on that wave 4 pullback. Then we get the next impulse leg, volume is slightly increasing, and it breaks this second one just, okay? Just, okay? So this is running out of juice now. We have a massive spike up. What's this again, okay? This is news or earnings again here. It starts to run out of juice, okay? So we followed the trend. We started with a range bound period. Somebody's leaked something about earnings or whatever it is, shortage of oil, if that's ever going to happen again now. And then we break out of the range. We start to get increased volume, the move up, we get earnings to help us move up. We then get some profit taking, which runs out of juice. We get a big rejection there, and we get some more momentum to move up to the upside. That herd is going. Then we pull back against there. People see value there. They buy some more, get that volume going up again. Then we start to move up on that last leg. Oops, let me get rid of those annotations. So what if we could measure this behavior in a consistent way? And this is important, guys. It's consistency. How do you measure that behavior in a consistent way with rules? So don't be afraid. I'm going to mention some technical stuff now, okay? But I'm going to keep it simple because I am simple. So we can use basic Elliott wave rules and observations to measure and track trend progress. Now, these never change. So if things don't meet that criteria, then that trend behavior is not normal, and we'd walk away from that particular section. So if it's on a 5-minute chart or a 3-minute chart for futures, if it's not behaving, it's breaking the rules, it's not behaving like 80% of trends do, then we walk away, okay? And it's the same with stocks. So some of you have seen this, some of this before, but it's really, really key to start the weekend with that basic herd mentality, understanding that behavior. The next bit now is it's covered in the boot camps for Elliott Wave, but we need to go through it. So now you can then see how we've built that story of understanding that herd mentality and that behavior and how we measure it using our indicator suites. So we're going to keep it simple. We're going to have 3 basic Elliott Wave rules which cannot be broken. We're going to have 3 basic observations of behavior for measuring a trend with Elliott Waves. And then we're going to put it all together to form a simple and repeatable strategy to trade the 5th and final wave of trend. Why the 5th wave? Because all the rules and all the observations have been met during that trend. Everything's worked out as it should do, so the probability is that last 5th wave is going to do what it's going to do, because everything else has worked out beforehand. So the rules, they cannot be broken. If they are broken, you don't take the trade. So rule 1, the wave 2 must not pull back or retrace further than the origin of wave one. Otherwise, that's not a trend, is it, really? It's a basic rule, but it's very, very important to understand how we build the picture here. So the wave one origin are the lows. We move up, we move down to the wave two, and that has a higher support level. So rule two, the wave three cannot be the shortest of the three impulse waves. And the impulse waves are the ones of the trend. So they're the 1, the 3, and the 5. Okay. So wave 3 in this case is longer than the wave 1. But you can see here, just here, this is the 5th wave. Now, in real terms, that's probably about the same. Okay. But I'm just trying to show you that it cannot be the shortest. A lot of the time, it is the longest. Okay. That's rule 2. Rule 3, and this is one of the most important ones here. This is where we get trend failures when that pullback is that the wave 4 must not pull back beyond the extreme of wave 1. And sometimes I know some of you that's been in the 5K club, some of you that are in the circle, you will notice that sometimes I trade those trend failures. Okay. So when I basically trade those wave 4 failures, whether it's up or down, because they're just as good for me when I'm trading. It's a different thing, but basically with this wave 4 must not pull back. Otherwise, this trend is over. Okay. So this is a rule. If we're going to trade that 5th wave, if we're going to get in on this trend, this wave 4 must not pull back beyond this wave 1 extreme. Really, really important. So the observations, now these are classic observations, but for me, they're just as strong as the rules, okay? So observation 1, so when we're swing trading that wave 4 pullback, we have 3 zones that give probabilities of a new wave 5 high. And we've most of you, if not all of you, have got that Elliott wave indicator suite, and you'll recognize those zones. So the first zone is the green zone. So when you've had that wave 3 impulse leg, if we pull back into that green zone, there is an 85% probability we're going to go on and hit that wave 5 high. The amber zone is an 80% probability. Still good, still good. The red zone, 75% probability. Still tradable, but it's close to failing. If it goes beyond the red zone, you are definitely rolling the dice, okay? It's gone too deep for me. Now, it's still not it probably will not break that wave 1 extreme at that point, but for me, the probability of that pullback to get the brakes put on, to find support and then go back up again is getting lower and lower the deeper we're pulling back, because it's like a car with fading brakes going down the hill. The more momentum you build, the more that you apply the brakes, the more it runs out. And basically the brakes, they wear thinner. You don't get that braking stability, and eventually you've just got to wait for the brick wall to stop the car. Okay, and that's what happens with a wave 4 pullback. The brakes have got to be applied. You've got to find the support before you go out of the red zone. So observation 2. So when you're trading this wave 4 pullback, the 535 oscillator, the Elliott wave oscillator, during that wave 4, has to pull back between 90 and 140%. Now this goes back way back to Elliottians, to high probability trading. This 535 oscillator, this pullback is one of those things that's set in stone for me. When you get that nice, just annotate this a little bit. Where we go? When you get this nice pullback here, and it crowns lovely and comes back during a wave 4, it's between 90 and 140. That is the wave 4 behaving very nicely. It's a nice, orderly, profit-taking pullback. There's nothing aggressive about it. People are just taking those profits, covering their positions, and it's orderly. Okay, observation 3 now. So I'm starting to build the picture a little bit more. This now we've got the stochastic. So some traditional stochastics are the overbought zone is at 75% for Elliott wave, and the oversold zone is at 25%. Now for me, I've always used 80-20. The 80-20 rule for me goes a long way in lots of indicators. But for me, it's just that it's the conservativeness, if you like, of getting over that 80%. Sometimes I've noticed in the past, if we just rely on the 75%, it turns down, we get the fail. So we want to make sure we get in and we cross over. So look at this down here. We cross over in the oversold zone, okay? Not only that, the false breakout dots on the top here denote a really strong bullish trend, okay? It's like, imagine the stochastic as a rubber band, okay? When we get that wave 4 pullback into one of those colored zones and it finds support, when we've got that 535 and that stochastic stretches against these false breakout bars, and then it wants to snap back up on that 5th wave target zone. So this is all the behavior that we talked about right at the beginning of this session being measured by traditional type indicators, but by putting them all together, and I've been using them for over 17 years now, it's actually measuring that wave 4 behavior. And I did a 5th wave trade yesterday live, took screenshots and put it up in an article. When all the rules are met, all the observations are met, there's a high probability it will go on and hit that 5th wave target. And we'll look at that later on in the session. But you know, there's a high probability that that trade, that 5th wave trade, is going to happen because all the rules have been met. We understand the behavior behind that pullback, but now that wave 4 behavior, the way we measure it, the checklist, if you like, is all there. We've got a good probability actually getting that trade going. So then we need to put it all together. So we have the checklist, okay, when setting up that 5th wave move, and they all must be ticked. When I started doing this a long time ago, I used to print out a checklist. I don't even know where it is now, but somewhere in my loft in my house in the UK, there are boxes of trade sheets, and I had a checklist to check everything off of those rules manually. So again, wave 2 must not retrace further than the origin of wave 1. The wave 3 cannot be the shortest. The wave 4 must not pull back beyond the wave 1 extreme. So those 3 rules, if you like, are taken into account with our Elliott wave indicator suite. Because if those rules are broken, everything's realigned and relabeled. So in theory, what we do is those 3 rules straight away, they're incorporated in that Elliott wave indicator suite. So we'll only label it a 2, a 3, a 4 if those rules are met. And there's certain percentages and things like that. It's all to do with algorithms and programs, but they're the basic rules. Then the wave 4 pullback into either of the 3 probability zones must happen. Again, we print those for you. The 535 oscillator pulling back between 90 and 140. The stochastic pulling back. So basically, if we've got all those ticks in the box, we're still not there, guys. We're still not there. What's next? You've got to keep out until you start to work on the important part. We need a simple and repeatable entry strategy with a minimum risk to reward before we go into the trade. So all of those ticks in the boxes can be done, but you still need to look at the entry strategy and the risk to reward. If they are not right, you still don't trade, okay? It's a multi-level rule system, okay? And this is the last bit. You can do all that work, and then this bit is really, really important. So conservative entry strategies for long or short, okay? We have the wave 4 pullback. Now we have the 6-4 moving average high. Okay. So the 6-4 moving average high is the green moving average. I think it comes as basic as blue on the indicator suite. You can change the color to green. For me, green is go. But we want to make sure that we are going along outside of this. So when we've had this wave 4 pullback, we start to pull back. We don't jump straight away. We want to make sure our entry price that we're planning on is outside of the 6-4 moving average high for longs. For shorts, it's the 6-4 moving average low, the red moving average. But also, you need to look left. So here, some people may think, I want to go short as soon as it leaves this 6-4 moving average low here. Look left. Look at these here. These were all rejections around that same price level. You don't want to be going short until it breaks that, okay? Because it could just go short, bounce back up and go higher, okay? We're in the green zone here. It's a good probability, but there is also a chance it could try and go up into the amber zone. We want to make sure when we're looking at these entry strategies, we don't just look at the 6-4 moving average low. We look left on a long or a short. Look what the rejection points were, okay? We need to go low below this, okay? So they're the final ingredients. Stop loss slightly beyond the wave 4 pivot. We've got an automated target zone that's printed for you. And we've got a minimum risk reward of 1 to 1.6, okay? So let's put that all together. So in this example here, this is Home Depot. This was an actual trade for me a while ago. So we have a wave 4 pullback. We have the 535 pulling back between 90 and 140. Somebody actually asked me a question the other day on a webinar, and they said, does it have to change a different color? And the answer is no. On that 535, as long as it gets below the 90, the behavior is normal. Sometimes it goes to 0 and then starts to come back up again if it's a shallow pullback. In this case, we found support right at that fib level there, the end of the green zone. So these are good, okay? 535, we've got a false breakout there on the stochastic. It's pulled back against it. We've got a great wave 4 pullback, find support around the end of that green zone. So everything looks pretty good. So our stop loss is just below the wave 4 pivot. Now, you know, if the low is $170 dead on, and this is $170 stock, there at that point, you don't go 169.99. Okay, you need to be around about, you know, between 0.5 and 1%. So you need to be, you know, around about 169.80, 169.90 type stop loss there. Obviously, if you're in a futures contract, you just go one tick below and that's it, because if it breaks there, it's going to go. Entry, again, when we discuss this, we're going to go outside the 6-4 moving average high. If we went here, if we went above here, we wouldn't get a decent risk reward. And this price, I'm new to these annotations, so just bear with me a second. This price, this pivot point here is around about 50% profit times risk. So we, you know, if we're managing this trade, once it gets to that point, if we start to seem to run out of juice, we can decide to make it risk-free if we believe that's the case. So now we put that, the risk to reward on. Now risk to reward, you use a fib extension, and we'll practice that a little later on. But basically a fib extension tool has 3 clicks, yeah? First you click at the stop. The second click is at the entry. And then the third click, all I do is move the mouse along and then click the third time at the same entry price. Now that extends, so this is 100% of your risk. And then when you see 100% on the actual fib extension, that's 100% of your risk there. Let's put those on. Okay. And as you can see here, this is 1 to 2. So potential reward is 200% times risk. This is a great risk to reward, a great looking trade. This is it in more detail. Again, you need a minimum risk reward of 1 to 1.6. And a lot of the time, if you've got a really good looking trade, you usually find that this wave 3 pivot is around about the 1 to 1.6. Usually I see it around 1 to 1.3, 1 to 1.5, 1.6. So even to this pivot point here, where that was the catalyst for, that was a price zone where traders decided to take profit, you've still got a decent risk reward to that point. But remember, the 5th wave is always higher than the 3rd wave. So we are looking for that push through. But when you're in this trade and it goes hell for leather and you hit that wave 3 point, you've got to make it risk free, at least at that point, just to make sure you're not going to lose in case people just dump at that price point. Quite a few, probably 20%. Sometimes you can see a 1 to 1 in stocks, especially. You can see a 1 to 3, 1 to 4 risk to reward, but usually it's about a 1 to 1.6, 1 to 2. But 20% of those trades, once they get to the 5th wave target zone, do push through and continue to go. 80% turn back down and are corrective. For me, when I traded that 3-minute ES yesterday, that 5th wave move, when it went into the target zone, took the profit. It was 40 ticks in 27 minutes. Yeah. So it's, for me, I know 80% of the time, 80-20 rule, when the price hits that zone, that 5th wave target zone, these are fib zones, you know, there is 80% chance is going to be a correction. So I just get out. Sometimes if it goes in there with high volume and really stop and good price action, I'll adjust the stop to around just below the wave 3 pivot, and I might give it a chance. Yeah, the fib is manually added, Gary. No, I don't. Not for this particular type of trade. And those moving averages are purely for entry, not for behavior. So entry, stop, target zone, risk, 1%. Again, when I'm swing trading stocks off the daily time frame or the weekly, I risk 1% of my trading account balance and risk 2. So for example, if you risk $10,000 or 20, so say for example you risk $40,000 on this particular trade, you would win $80,000. That sort of thing, and that for me that's a good risk to reward, and that, you know, that's the last ingredient, if you like. So again, we're looking at that short now. Stochastics crossed over in the overbought zone. 535's looking pretty good there. We've got a pullback into the green zone. We've got the entry, got the stop. We've got a risk to reward of 1 to 1.6 into the target zone. Look at that a little bit closer. Entry, stop, target zone down there. The risk, 1% of the trading account balance, and the reward is 1.6 trading balance. Okay, good. Minimum risk reward is met. Now, if the risk reward is at the bottom end of that zone, it's still good. So if I just to show you that there a second. So if the 1 to 1.6 is right at this point of the target zone here, that's still fine. It's in the zone, okay? And again, you have to make that decision by yourself. You know, is this risk reward good enough for me for this trade? Okay, so we can also use aggressive entry strategies. Now, for this, so it can be employed when an instrument is trending, and you know it has an orderly wave for pullback. Everything else, you know, puts together right. And I use a regression trend channel for this with a standard deviation length of 8. Okay, price close, deviation curve coefficient -1, and 1 with the center line visibility. So I'll say that again, but again, this is recorded, okay? I can go aggressive if I feel that the trend is really going, okay? For example, this particular one, you see the earnings down here, we'd already have the catalyst, and then we've got a really great candlestick pattern piercing line here. It did have high volume. I wanted to go more aggressive, so I use a regression trend channel to do that. You can see how much more aggressive that is in the 6-4 moving average high. Okay, so again, standard deviation length is 8 on a regression trend channel. We've got the price close and the deviation curve coefficient of -1 and 1 with the center line visible. Center line is really important. It actually gives you how that particular regression trend is working. So for me, we've got a risk to reward here. So of 1 to 1.6, the top end of the channel. Now, this is key for me. You can go very aggressive when it breaks out of this channel. But again, looking left, I've got this little candle here, this little doji of indecision. I want to make sure my entry's above there. So it's more aggressive than the 6-4 moving average high, but we're not going ultra aggressive outside of the regression trend channel because I have this little thing here that's really going to give me concern. So I want to make sure I'm above that. So risk to reward and the target zone. So 1 to 1.6, the top end of the target zone. I think it was, you know, so, you know, risk to reward's good. It's more aggressive type entry strategy. And depending, for me, the wave for pullback is between 7 and 10 candles for perfect. Yeah, for the perfect wave for pullback. So this one has 1, 2, 3, 4, 5, 6, 7. Okay. And then we get this gap up here, which holds. So for me, if I get the 7 pullback and starts to pull away, I really do seriously consider a more aggressive entry to make more money. Okay, but I always still have to look left. So I don't tend to take any off, okay, because it really dilutes your trade. So I'd rather make it break even and 80% of my trades go to that target zone, for example, or 85 if it hits the green zone, rather than taking some off the table, make it break even, and then it finally gets to target zone and you've diluted your trade. Okay, so for me, I'd rather make it break even when it gets to 50%, come back, take me out, not lost anything. But 80% of those trades will go on and hit that target zone, for example, or 75 or 85, depending on which zone it's gone in. And you will get the full whack of that, that profit. Does that make sense, Matt? I've never been one to dilute a trade because remember, this is a probability type trading strategy. And the probability is with you that it's going to go on and hit that 5th wave target. So if it does, you've already diluted that particular position. To be honest, I'd rather add. Peter's in this room now, he's part of my inner circle. When we traded ES the other day, I added another contract. I didn't take any off because momentum was going with me. So I added more to it. I didn't take anything off. So, you know, I'm the opposite way around. So stop loss, entry, 1% of the trading account balance. And again, this is me. This is on a stop, and this is swing trading off a daily time frame. Okay. Now, you might not want to risk 1% of your trading account balance on a futures trade on a 3-minute time frame. Again, that's a different type of strategy, and that's your risk tolerance, what you're prepared to risk every single trade, depending on your account size. You know, you can't go long oil, for example, on most brokers at the moment because of the leverage and all that sort of stuff. So it really depends on that. So the strategy is now complete. So without a minimum risk to reward of 1 to 1.6, the trade is no good. You've got to have the discipline to walk away. Okay, your job as a successful trader with continual profits every month and every quarter is to be disciplined and to find reasons not to get in a trade. If you can't find those reasons, all the ticks in the boxes are there. You've got a good risk to reward. You've got to trade it. So again, checklist, again, the same thing. Those rules, those observations, and now the risk to reward. That's the biggest thing. If the risk to reward isn't there, you've got to be prepared to walk away. Okay, so it really isn't rocket science. You need to understand how the market behaves, how it's forming a trend, a way to measure that trend, and a set of rules to help you set up to get into that trend. If you follow those rules, you will be consistently profitable with a simple and repeatable trading strategy. A large number of traders fail because they don't keep strictly to a set of rules when identifying potential trades. So, you know, I've used this core trading strategy for, you know, way over a decade. And I've had consistent profits because I don't try to stretch the rules. They're there, they're simple, they're repeatable. You just have to get all the ticks in the boxes and you're good to go. So hopefully you found that first session helpful. Okay, we are going to do another one on volume in a minute. I just want to exit from there. And I want to pull up, let me just pull up, I just want to pull up yesterday's trade. I don't know whether the wave count would have changed now, but I'm just going to give it a go. Let me move that out of the way. Go 3-minute on ES. Obviously, if the rules have been broken, it's changed. The wave count would have been changed. Okay, so it ended up going even higher. Okay, so this was a 3-minute chart yesterday. What I want to do is just go to show you. Okay, so this was the trade. Let's discuss this as we've just talked about. Let me just add the stochastic to this chart. Okay, this was textbook, okay? In the European morning, roller coaster trade, boom, yeah? And this happens a lot. The wave 3 then finds resistance, so it runs out of juice, if you like, at the top end of one of my support and resistance zones. We have an orderly wave 4 pullback. Now, this is more than 7 to 10 candles, so I don't go aggressive, okay? The wave 4 pullback, between 90 and 140, really beautiful crown. I do get a false breakout on there on the bottom, but that actually was done after I entered, because I look for an entry at two just above here, look. So around about 2799.25, I think it was exactly. So again, let's just put those in and I'll show you how to use those risk rewards. So first of all, I'm going to use the fib extension tool. Okay, my stop is one tick below the wave 4. I want to make sure I'm above all of this noise and the 6-4 moving average to go long. Okay, this high here was about 2798.25. If I look left, I've got a high here as well at 2798.75. This is no coincidence. It was a rejection. So my entry strategy has to be above there. Okay, oops, I didn't mean to click there. I'll do that again. So I've gone one tick below, click once. I've got to be above there. I think I had a 299.25 in the end. I give it a little bit more space. I click for the second time, and then I move it along the same price, and I click a third time. Okay, so my stop was just below the wave 4. My entry was clear of all of this and this on that left shoulder. 2799.25 was the entry. Risk to reward 1 to 2 into that 5th wave target zone. 535 is good. Stochastic was good at the time. It didn't print this false breakout until the next candle, okay? And you know, that happens, but everything was good for me. I've written the article on how I traded that. If you wanted to be ultra conservative, you could have gone long at the roller coaster. But the main thing is, with this lesson that we've just done, this is a 3-minute chart on a futures contract. It's not a daily chart, which I've just used there as examples in that lesson. See how it hits the 5th wave and then we go corrective. I took my profit in the 5th wave, guys, okay? Because 85% probability it's going to go and hit that 5th wave, and there's an 80% probability it's going to come down off that 5th wave because it's a fib zone, and it did, okay? So the article is on the blog to show you step by step how I managed that trade, and that's definitely worth a read on the Trade the 5th blog. I actually put that on there yesterday, and I traded it. I had my broker dome on there, the live account. I only traded 3 contracts, micro ES. I only worked out $160, but it was there just as a teaching thing, okay? But I wanted to trade it live so I could go through the process like I always do of putting the trading stops in. You can see how we had a big move up to this 100% line in and around that wave 3 zone. It did stall a little bit and then pushed through. Perfect textbook trade, perfect setup. Wave 4 pullback into the green zone, 535, 91.40. Stochastic pullback against that false bar on the left. We've got a sensible entry strategy above here. We put the risk reward on 1 to 2, go. There's no thinking. It's go, okay? The US Open wasn't until 15:30 my time here. I had loads of time to get this trade in, loads of time. So one thing is, if that had happened closer to that open of the US markets opening, I maybe would have not entered that trade. But this was at 20 past 2 my time in the afternoon. 3:30 my time is when the market's open, and on a 3-minute time frame, an hour is a long time. So this was perfect. You just gotta go. Okay, any questions on what we've just covered in that first lesson, or about this particular trade setup, or the or anything like that? Let me know in the chat if there's any questions. You can if you want to have a quick discussion, you can unmute yourself to ask the question, but don't all unmute at the same time. Otherwise, it'll all be a little confusing. If that makes sense, we'll crack on. Okay, so what I'm going to do is just going to pause the record. Okay, so the next lesson is volume, price, action, and behavior. This is important. Okay. So, volume. This is a simplistic view of volume, and it's like throwing pebbles at a glass window. You throw one pebble, and it won't smash the window most of the time, okay? Depends on what sort of throwing arm you've got. But lots of different sized pebbles at the same window, and we equate that to shares, eventually you're going to break that window, okay? And you're going to push the price higher, okay? So when you've got low volume, it doesn't push the price up, okay? But when you've got multiple orders, all of different volume, all adding up to a higher average volume, you're going to break through. So if one investor places an order for 100 shares of a stock or 10 contracts of a futures at a current ask price, the instrument may not move up. But if 10 investors all place buy orders at different quantities, the stock is most likely to move up in price because there's just not enough sellers. And the brokers then need to entice those sellers to sell with a higher price. So, you know, some things that, you know, ES is at 2,800, but there's not much volume there because, you know, the broker needs to entice you. So it puts the price up to 2,825 or 2,850. No one's taking it. Let's put it 2,000, you know, 2,875. All of a sudden, boom, 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 boom. Yeah, it goes. And it's when there's not enough sellers, the broker has to entice you by putting the price up. So you're prepared to sell that share, that stock, shares of that stock or that. So that's how we get that volume, if you like, pushing up. So let's move on. So not enough sellers. So average daily volume. I got a degree in maths and this is still complicated, okay? You don't need it. That was the official formula for working the average daily volume. Okay, so that's what a volume chart looks like, okay? So we're going to use average daily volume for stocks, as this is, you know, it's the origin of the theory, if you like, as a daily time frame for stocks, you know, is the purest of all. We have an open, a close, a high and a low. Then you pull all of these days together. So each one of these lines on this volume is a day's worth of volume in a stock. So I just wanted to use this as an example, but it's still the same for futures for every 5-minute period. But this is, you know, this is a purist way to discuss it and talk about it. So by knowing the total volume on a day, you can understand the power or the influence on a given stock. So the greater the volume, the greater the influence on the price to change, okay? So the greater the volume, the greater influence for the price to change. So this allows us to identify accumulation and distribution days. I'm going to go through those and what that means, you know, on a stock chart. And we can be used, you know, to identify current momentum and predict future price movements. So no need to use fancy formulas and tools. Okay, use your eye. The line of best fit, that will give you a rough idea where the average daily volume will be. So, draw the line, okay? When you do line of best fit, don't know if there's any engineers here, I'm an ex-engineer. Line of best fit, that is round about the average daily volume. So when you've got volume below there, it's very low volume day, and when you've got volume really high above there, that's higher than the average daily volume. Okay, There's more influence, for example, on this particular day. It takes a while to get this annotation tool. So this particular day here and this particular day, okay, there was a lot of influence by buyers. There's a lot of volume going in there, okay. So you've got to consider that daily average volume overall over whole trends, but also each wave has its own average daily volume as well. So when we go back to that behavior of the 1, the 2, the 3, the 4, the 5th waves, there are certain distinct patterns that you're going to be looked for. And we're going to discuss those in this section here as well. So volume, very important. This is being recorded. When you turn up live to New York, you will get a workbook. I know some of you have already been to some of the live sessions. You already got those workbooks. So there's no need to worry if you don't get it first time. Okay, so we're going to understand volume. We're going to go back to what we just discussed there. Volume accumulation days, okay? Volume accumulation days, volume distribution days. I've color-coded these. Volume accumulation days, up volume. Volume distribution days is selling volume. And then we're going to look at volume during the wave 3, the wave 4, and the wave 5. And volume during trade management as well. Not a lot of people cover volume. To me, it's 50% of the picture of understanding that trend behavior. Price action is good, but without volume to really back it up and understand what's going off, you've only got half the picture. So this really tells the whole picture with volume as well. Okay, an accumulation day is when people amass or accumulate more shares at the ask. So putting in buy orders, if you like. So then at the bid, putting in than people putting it in orders at the bid, sell orders in a single day. Okay, so I'll repeat that. An accumulation day is when people amass or accumulate more shares at the ask price. They're putting buy orders in. Okay, there's more of those putting in than those sell orders. So if a stock has 2 or more accumulation days, then we can say it's looking pretty strong, it's pretty bullish. So those days are those volume are increasing every single day. So remember, the second accumulation day, the daily volume has to be higher than the previous accumulation day's volume. And that volume increase is steady in a trending wave. So let's have a look at that here. So we can see, first of all, this was the volume on one given day, bullish volume, okay? The next day, we have increased volume than the previous day, okay? That's an accumulation day. The next day, it's the same. We can class that as an accumulation day. Then the following day, we get even more. We've got accumulation days. We've got volume picking up every single day, or if this is a 5-minute candle, every single 5-minute candle, okay? This volume is increasing steadily in a trending wave. So we're building volume every single candle, every single day, every single 5-minute candle, if you like, but the volume is increasing on that ask side. People are putting more buy orders in. That buying volume is increasing. So, volume distribution day. Don't get confused with these lines going up. It just denotes how much volume. So since we are giving out, dispersing, if you like, shares, we're really selling our shares in a sense. So the first major point to note about distribution days, it's related to the selling of shares, not buying, okay? There's more people, buying is accumulation, selling is distributing. So there's more people selling, putting those sell orders in, and people are just buying at those sell orders, okay? So this is the most important piece of the puzzle, when looking at distribution days. For a day to be considered distribution day, the stock not only has to end down overall, but there's also has to be more volume traders. So this is where it comes a little confusing, in that we can see these lines going up on this screen right now. Okay, you can still see the screen, can't you? You know, I'm not talking blankly here, but actually the price action's going down. So again, if the stock has 2 or more distribution days, then we can say it's looking pretty weak, pretty bearish. Remember, the second distribution day, the daily volume has to be higher than that of the previous distribution day's volume, okay? So for a distribution day to be considered heavy, the volume not only needs to be greater than the day prior, but also greater than the average daily volume. Now, you'll see this a lot when people are selling, okay? Not so much when they're buying. When you've got big sell-off days or candles, if you like, you will see a massive spike in volume, a lot bigger. So that's when we say it's heavy, okay? If selling is heavy, it's not only a distribution day, it's a lot bigger than the average daily volume as well. Things go down a lot faster with a lot more volume than they go up. So here we have selling on this particular day. The next day we have more selling. That's a distribution day. But then we peter off, okay? So this is not a distribution day here because it's less volume than that day. Then we get a distribution day. Then we get a distribution day. Then we, whoa, go back. Then we get this heavy distribution day. If we put a line of best fit here, it's around about, let's draw it in. Draw a line. Okay, line of best fits, we are about there-ish, okay? This can be classed as a heavy distribution day, but this one is twice as much. So this is a real big heavy distribution day. And if you're going long on something and that's appearing, you should be out. Okay, so this is distribution days. It's going to become more clear as we move along. So remember, just to remember again, that the volume increase is more acute compared to those accumulation days on distribution days. And I call it dumping, okay? So people dump a lot more volume when that herd starts to move down. Okay, volume during a wave 3. Remember, wave 3 is never the shortest impulse move, but usually the longest. And actually, there are sections of a wave 3. We can actually section this, and we'll talk about those now. Okay, so this is stage 1 of a wave 3. So the initial impulse has a more collection of accumulation days with increased average daily volume. Okay, so when we look at these green candles here, we look at the okay, so we've got distribution there, we've got accumulation, we've got accumulation. Okay, so we have more accumulation days. Let's go back one. We have more accumulation days than we do distribution. We've got one distribution volume here, the rest accumulation. But look at the size of this. This really starts to pick up momentum. And this next day here is even higher. So that first leg of that wave 3, that first impulse has a lot of volume. So the next stage of a wave 3, and this behavior does happen more times than not, okay? The average daily volume drops and then starts to pick up again with volume peak higher than that of stage 1, okay? Now this is normal. This is what happens on that second stage of that wave 3. So when you're looking at these wave 3 forms and you think, this is going to run out of juice soon, I'm going to wait for this wave 4 pullback, you need to be trying to figure out which stage is it in, which of the 3 stages of this third wave is it in. And so we get this big impulse move first with more accumulation days. And then we see in the second stage, we see the average daily volume pull down, it finds a bottom and then pulls back up again. And you get real big accumulation days towards the end as it gets to that peak, and it actually breaks the high volume of that first impulse move, okay? So we've got to also understand this, this area here on the end of stage 1, this massive move of accumulation days is the catalyst for this lowering daily volume, because, you know, this point here, there's some selling, there's some profit taken during the wave 3, but it really does run out of juice quite quickly here. You see the average daily volume move down. So the next stage, again, we've got those there, but I've just talked about that there. So we get that big move up on stage 1. Then we get some distribution days here. That's the catalyst for starting that profit taking during wave 3. But look, these are the breaks. These accumulation days are breaks. It's starting to slow that down. The average daily volume's coming down. Then we start to pick back up again. And then we get these huge accumulation days here. And these are much higher than the average daily volume. Now we got stage 3, okay? Notice the average daily volume is higher than stage 2, okay? So when we look at average daily volume down here, let's put these lines on. Average daily volume here, line of best fit is around here-ish, okay? Average daily volume here is around about there-ish. Yeah, so the average daily volume is higher during the phase 3 than on phase 2, because we get this big dip down and then move back up again. Okay. So we've had this big move up, then we have a big drop, but we don't get selling. What we do is we get the average daily volume of these accumulation days really drops. Okay, and this, I think some of you have heard me say it's running out of juice. The wave 3 is running out of juice. So these 3 stages of wave 3 are very important as far as understanding the behavior and when a wave 3 is running out of juice. And you'll usually find the stage 1 is like this, the stage 2, you get this really low drop in average daily volume, then starts to pick up again and it peaks higher. And then the stage 3, although we get that higher average daily volume, the accumulation days are nowhere as aggressive than that. And you can see here, these peaks of these volumes really coming down there. Again, we've got a lot more accumulation days. So there's still some bullish momentum there, but those volume days are dropping, okay? The average daily volume is lower. We get a distribution day, which is a catalyst then to start to come down even further. The breaks come on again with an accumulation, couple of days there, but the average daily volume is still dropping a little bit. It's higher than there. So we're getting towards the end, the top of that roller coaster, if you like, and we're starting to run out of juice. Okay, that's the wave 3. It's quite complicated to go over in one time. Again, this is recorded. You have the work booklet when I go to New York. In fact, we may get JW to send them by post because he's got them in the US to you guys. So if you email him, JW will email the work booklets to you, send you them by snail mail. So that's the wave 3. Now, volume during the wave 4. Okay, remember we talked about understanding behavior of wave 4. It's not just price action, it's volume as well. So wave 4 usually starts with a higher than average daily volume distribution day or days as a catalyst for that profit taking. So when we look here, we can see this distribution day. This is the top of a wave 4. Okay, so all of a sudden now there's more sell orders going in, and not just that, for 2 days on the trot, those distribution days. So that's what we call the catalyst. Gary, the t-shirts I will sort out myself. I will just need all of your addresses, but we'll get JW to get all your addresses by email. So this is the catalyst for that wave 4 pullback. Remember when that wave 3's ended, we talked about behavior. We talked about that those people that got in really early wants to start to take some profit. It's those people that dump some shares at that peak when we start to see that wave 3 run out of juice in that 3rd stage. We start to see then the catalyst for that is that type of a distribution days there as a catalyst for that wave 4 pullback. So then we see during the wave 4 pullback, we get a couple of accumulation days here, but the average volume is dropping. Then we get some distribution days. Well, we get some more distribution days. Then we get some more distribution days. So there's more selling going off because this is a profit-taking pullback, okay? So remember, the wave 4 is much shorter in days than the wave 3. Remember, for me, a really great looking wave 4 is between 7 to 10 days. But again, we've got to look at the 535, the stochastic, and those pullback zones as well to give us that real guidance. But it has to be a minimum of 7 days, guys. If it's only a 4-day pullback, it's not a great looking wave 4. Okay, so remember, and if you write this down, stick it on your wall, a wave 4 has to have a minimum of 7 days pullback for me. If it's less than that, it's not really a good looking wave 4. Volume during a 5th wave. So this, again, this was the volume at the end of that 4th wave, those distribution days, okay? So then we start to get higher closes, but with lower volume as the price moves away. It's still weak at this point, okay? So we're getting bullish days, but the volume is dropping off each day. So this on a wave, at the end of a wave 4, is where we get that bottoming out, where we get that basing, if you like, in that there's no real interest in selling in great deal of volume now. There's more buy orders going in, but the volume each day is less. So it's almost like the brakes are coming on. It just takes a while for it to stop the car, if you like. Then we get a large accumulation day, sorry. We get a large accumulation day, which actually then potentially kick-starts that 5th wave, okay? Then we get this, what would you call it now? I'm trying to think of the word. I've lost my train of thought totally. We get this lowering of volume, this range period where we've got that catalyst, which basically starts us off on that potential 5th wave move. But then we get this period of time where we get just low volume, low average daily volume. We've had that catalyst. The price is pretty much staying where it is. We need some more stimulus to actually get that going. And that stimulus could be a news event, or it could be, and most likely be an institutional trader saying, do you know what? This looks like it's found support now. It's moved away from that wave 4 low, and usually you'll see this big accumulation day here start that, and then it's gone a little rangy as far as price action and volume is concerned. It doesn't look like anybody wants to sell this. This looks like a good opportunity. I'm gonna buy, okay? So you get that first accumulation day, and then you get another accumulation day. The volume's still not brilliant. It's around about average daily volume. You get another accumulation day. Then you get some more. The volume starts to really start to pick up now. It's getting above average daily volume. That momentum on that 5th wave is really going. you get a little distribution day. There's some early profit taking there. And we'll do that tomorrow. Sometimes you get a little ABC correction during the fifth wave. Then we have a massive power drive of accumulation days into that fifth wave, okay? As again, so it's about understanding how that behavior works. So the brakes have got to come on from that selling, from that profit taken on the wave 4. That happens progressively. We get more buyers interested, but they're not really putting the volume in there to start to turn it back up. They're putting enough buying volume in there to start the downward momentum. Then we get a push away from that wave 4, which is this accumulation day, but then there's lack of appetite to start going up or down. Most institutional traders, if we're in a bullish trend, will see that as an opportunity that there's selling, there's no interest in selling right now. Maybe if the broker puts up the price, if I bid at this price, somebody will sell, and they do. You get more volume, you get more accumulation days, that starts to build up, and your wave 5 progresses. Okay, so volume with trade management. So this is that same chart, KSS, that we just did on the fifth wave. We'll talk about trade management now. So this was the trigger that we talked about earlier. That was a trigger for that fifth wave move, if you like. Then we had the sideways volume. As you know, we get that contraction, you know, extension of those consecutive accumulation days. It's really, really tough. But then we get those accumulation days, which starts that momentum going, okay? But then we get this distribution day, okay? Now is the time when we're moving up on that fifth wave move. That's a sign to go risk-free, okay? It could continue. You don't know. You've not got a crystal ball. But the volume is increasing every day. We've got accumulation, accumulation, accumulation. All of a sudden, we get distribution. This could be a warning sign. You can't look right. You've not got a crystal ball. But now is the time to think, I'm going risk-free here, just in case it tumbles. Yeah. Okay, so then we get this big move up, probably very close or if into the fifth wave target zone. So at this stage, we don't know going to get, if we do, you know, we don't know if we're going to get any continuation or not. But then we start to pull down, the selling starts to come, but that starts to go low again, okay? And what this is this volume's running out of juice. Now, this didn't hit the wave 5 high here. What happened is, like on a third stage of a wave 3, the average daily volume is higher, but we start to drop off in volume. Okay, this is not a distribution day because it's a lot lower volume than that day. So that's just some profit taking. That's more selling going off. The brakes are starting to come on a little bit from that selling. We start to, you know, peter out. There's more buying that day, but then we get an accumulation day. You know, a distribution day, and that's, you know, that's some slight profit taking. You know, the consolidations of these green days, it's running out of juice. Remember that third stage of that wave 3. This is working exactly the same way. The average daily volume is higher, but we're running out of juice. And if you're in that fifth wave target zone or very close, and this volume is dropping off, you need to be getting out and taking your profit. Okay, you get another distribution day there as well, you see. So this is a sign, yeah? If you're not out here, you need to be out here, okay? You've had the big peak. Now we've dropped in volume. It's running out of juice, whether it's buyers or sellers. There's total indecision. If somebody, one big boy comes in there and dumps his stock at that fifth wave target, it will go down massively. You will need to get out. So now we're going to start to introduce price action, and these are specific types of price action we want to talk about, and then we're going to add the volume that we just talked about to that price action. Okay, so we're going to talk about a collective price action. So we're going to look at support and resistance zones as well. It's not just candlestick patterns, if you like. We're going to highs, lows, pivots, and trends. Specific price action is the candlestick pattern. So collective price action, some of you or all of you know on the 5K Club, I put these support resistance zones in. Okay, so these are collective price actions. These are where a price will go up or down to test a specific price zone. It's not a dead-on exact price, okay? And collectively, over time, it tests that and rejects it, either support or resistance, and those form zones, okay? We're going to look at highs and lows, pivots and trends, and then specific price action, candlestick patterns, which will help us with this particular strategy. And then we're going to look at wide range rejections and contraction, okay? So support and resistance zones. These for me are something I do every single day. I put them in there. So we've got a collection here. This is the start. Okay, you're not going to draw it until you get somewhere down here, but I just want to show you how I pick up these zones, if you like. So this zoomed in here is we've got these, we've got a hammerhead, so we've got a rejection, we've got another hammerhead doji there. So this is finding support there, and it moves away. We get a similar sort of price action again around about that same price zone. Okay. Now we're actually testing the bottom of this zone 1, 2, 3, 4, 5 times. We're starting to then be able to see what that collective price action is in around that zone, the high and the lows of that zone, okay? So we can see here on the top, let me just annotate this. Here, the top end of my zone, around the bodies or the bottom of the bodies of these dojis, okay? That, and again, we've got that bottom here of that body. So this is forming the top of my zone here. And it does here as well, look, okay? This is in the middle of the zone. But what we want to do then is look at this position here. This then allows us to form the bottom of our zone. Okay, now this zone then just needs to be extended right and continue to extend it right, because there are major decisions being made at the top and bottom or within this zone of price that are going to affect our trading decisions. This is why in the 5K Club, I put these zones on and I keep extending them right. Even if they take another 3 months to come back, decisions will be made out there, because institutional traders are drawing these zones. They have very intelligent software that does it for it. We can draw more zones as well. Again, we get big tests and a massive rejection here. That's potentially forming another zone, okay? We get a test again on these days, okay? So if it's tested it once, twice, 3, 4, 5 times, that's a pretty strong zone. Trading through that zone and down, great short, okay? So does that make sense? This is not an exact science, okay? But you can see on these other zones here, if I just annotate here, we get this rejection doji here, we form it once, okay? We get the bottom end of the zone there again. Top end of the zone is more clustering rejections here, and here, okay? It's not an exact science. I never remove the zones, Tim, never. Especially on a stock, because 3 years later, you might come and test that zone again, and you need to be reminded that that price zone was a decision point for institutional traders in the past, and it could be again. So if you want to go long, but you're approaching one of those zones, you really need to look at what happened. What was the volume like? What's the volume like now? What's the price action? You know, was there earnings there or anything like that? So again, there's a lot of things to take into consideration, but I never remove a zone, never. Okay. So highs, lows, pivots and trends. This, again, those that have attended this training live with me before, or those in my inner circle, or go to the 5K club, I tell, what do you see? Talk about what you see. No, so we're going to talk about some specific types of scenarios here, which do occur quite a lot. So the price barely making new higher highs or lower lows. That's one instance. Running out of juice. The highs and lows forming strong chart patterns. We're going to look at some of those. We're not going to go overboard. We're going to look at ones that occur the most. We've got to keep it simple and repeatable. We're going to look at long trend channels with small pullbacks only. Then we're going to look at larger candle wicks whilst price making new highs and lows. And then short-term reversal swing point pivots. So we're going to look at these now as far as price action is concerned. Okay, so price barely making new higher highs or higher lows. Okay, so this is price action. So we see here higher high, higher low. Higher high, higher low, higher high, higher low, higher high, higher low. We do get a little pullback here. This is a sign to go risk-free, for example. Then we get a high high, high low. Then we get another little pullback here. Again, another sign to adjust your stop. Something's running out of juice. Then look at these three here. Higher high, higher high, high high. Very, very small. What I say is running out of juice. So these price actions are barely making new highs. So this is great, okay, perfect. We get a rejection candle here, which is good, but this candle is worrying. When this candle closes, we need to make sure we are risk-free or we are managing the trade correctly. We then get let out of jail free because we then get a good higher high there. But this is an engulfing pattern here. Then we get another good higher high, high low. Then we get a little bit of a pullback and congestion again. And then we start to see this. This barely higher highs, higher lows, a really good sign the price action is just running out of juice. And it works the same for lower lows. So again here, great momentum, and then it just starts to run out of juice. Can you see how we've got momentum here? Lower lows, lower lows, lower lows. Then all of a sudden, barely lower lows. So this is understanding, we've just gone through volume, we're going to do price action, I'm going to put them together. But this is understanding price action, behavior, what's happening here. These barely higher highs or barely lower lows is a sign that we're running out of juice, and you usually see it in 3 or more candles. Okay, I'm not saying that's 100%, 100%, you know, exactly true. It could be, you know, 2 candles, then it goes flat and starts to come down, but usually 3, maybe 5 candles, then it might go range bound, and then it might go up or down. But the main thing is it's that warning sign for you that you're getting those barely lower lows or higher highs. And it's understanding that price action behavior. So highs and lows forming strong chart patterns next. Head and shoulders, big one for us, because we don't want to make sure, we want to make sure if we're going into a 5th wave move, we're not going to get find resistance at the head and shoulders. Okay, so head and shoulders high. Yeah. So here we've had some resistance. Okay, it's clustered around this shoulder. We don't know that's head and shoulders if we're at this point here. And then we push up. Remember that volume that we said pushes up really onto the wave 5. Then we get the catalyst for the wave 4 pullback. Okay, so we've got that high there. But then all of a sudden we bounce back up and we get some clustering again to form that right shoulder. You can see how the right shoulder is slightly higher than the left shoulder, mainly because we're in a bullish trend. But that really, you know, in a bullish trend, that is usually the case. So then we get this wave 4 pullback continue. So when we're working out our risk reward for entries and things like that, we need to consider this head and shoulders pattern, because people would have gone short below here. Okay, if we go, we get the left shoulder, we come up, we make the wave 3 pivot. We come down, we find support, we come back up, we get a slightly higher right shoulder. People are going to go short through here, okay? When that happens, that wave 4 continues. This is a real corrective type of wave 4, okay? It's ugly, but it still works. But you just need to be aware, when you're thinking of going long on the 5th wave, these shoulders could be some problems for you, okay? So when you're working out your risk reward or you're managing that trade, when it starts to approach this sort of price, you're going to make sure that you are risk free, okay? But also, if you wanted to, you could trade this trade, and we're going to talk about ABC corrections tomorrow, because this is a classic trade where you would go short going through the A pivot here. Once you've made the B, you go through and you trade the C wave from the A pivot and down to those projections we talk about tomorrow. So that is another alternative there. But it's about understanding what's going on, what's that behavior. So highs, lows, forming strong chart patterns again, head and shoulders low this time. So this time we've had a wave 4 pullback, okay? It's been ugly. This time we've had a higher left shoulder and a lower right shoulder, okay? We've got the wave 4 pivot here. When we're going long, we need to make sure we're above all of any noise, okay? So remember, on a traditional wave 4, we need to be going long outside the 6-4 moving average high. And excuse me a sec, guys, just going to get some water. Okay, I'm back. My voice is running out. I'm not used to talking so much. So we've got a top end of this shoulder here with these pivots here. When we're going long, if we went long out of that 6-4 moving average high, we're below the bottom of this shoulder, okay? If we formed a shoulder here, we want to make sure if we're entering above that shoulder, okay? This was a double bottom at that point. When we're looking to enter a wave 4, although we say go outside of the 6-4 moving average high, we really do need to consider what's happened left here. And that is important for our entry strategy here. We're then in the trade. Oh my God, it pulls back. We get that higher support level, okay? We then form this head and shoulders with the low here. This is good. When this starts to move back away again, I want to add to my position when it comes through these highs here, okay? I'm trading the 5th wave. There's a high probability this is going to happen. We've formed a head and shoulders pattern. We've been conservative with our entry. It's gone up. It's found resistance. It's pulled back. It's got a higher support level. We should be able to recognize we've got a head and shoulders pattern here with a low. Higher support level, I'm going to add to my position when it goes through this pivot point here. So we started with 2 contracts here, or 1 contract. At this point, it's pulled back. We've got a higher support level, head and shoulders here. This is brilliant. When it goes through this pivot, I'm going to add another contract. There it goes, okay? Or shares if you're trading stocks. Okay, double top highs, okay? Again, this is why we draw the zones in, guys, because we can spot these double top highs. Oops, let's go back a second. So we get a double top high here. This could be over quite a long time, but this is crucial. We go short. Through this pivot. Okay, really, really important here. We get this longer term double top high. We start to pull back. We look at the volume, stage 1 of the wave 3. Okay, we pull back slightly. We're in stage 2 of the wave 3. We're going short below here. We're in stage 3 of the wave 3. Okay, this was done before the roller coaster. This would have been a roller coaster trade. Okay, so then we're in the wave 3. We go the wave 4. Where does that wave 4 find resistance? Very close to the entry for this double top high type trade. Okay, this is no coincidence. This looks like a really good wave 4 now. I want to trade the 5th wave. Okay, again, understanding behavior, looking at some basic chart patterns, looking left, framing your chart, really, really important. Okay, even if you didn't go short through here, trading those stages of that wave 3, when that wave 4 comes back up and tests that proximity, starts to turn back down again, that's no coincidence. I've got to go in. Double bottom low. Okay, double bottom low here. This is really rangy, but we've got a great double bottom. Double bottom is 3%, okay? Doesn't have to form, excuse me, at the exact price. It's 3%. So if this found support at $100 right here, okay, and this came down to $98, it's still a double bottom, 3%, okay? And then this actually forms the basis of one of the rules we put into the algorithm for the roller coaster, okay? So we get the wave 1, the wave 2, you know, wave 3 now, we get that first stage of wave 3, we get the second stage, we get the third stage of wave 3. What happens? A lot of institutional traders will trade going through that pivot there, okay? You've cleared that pivot of rejection, you've had the double bottom. On a double bottom, the trade is below the high pivot, okay? We're tracking this, we've had a 1, we've had a 2, we've had the first stage of wave 3 with the volume. You'll see that volume really peter off, then come back up again. That's a stage 2, then stage 3 starts to go. Trade along there, okay? And then you get a wave 4. Where does the wave 4 find support? At that point there, look, rejects there. This is so important. You really need to understand what happened left, guys. You need to understand, I keep saying this, you need to frame your chart. Was there a double bottom? Where's the pivot for the double bottom? Double top. All those things, you need to frame your chart. If you're trading a specific instrument or a specific set of stocks or, you know, whatever, that's why the zones stay on. When you see this chart pattern forms, these pivots, you know, you really need to keep them on to understand to look left. And when you get a wave 4 pullback and it finds support at this previous pivot, this is a great looking trade. clear all of those. Okay, long-term trend channels with small pullbacks. Sometimes you don't get great pullbacks on a really strong growth stock, for example, or if something's on fire, you're just getting a really, really strong move up. Sometimes you don't get a pullback on the time frame you're looking at. You have to go down time frames, but you need to put it this way. I did it for 3 years and I got burnt out and I, made my money and I retired, that. But institutional traders constantly add to their positions on small pullbacks in really strong bullish momentum, and they go tight in the channel as well. So there's lots of opportunities in a channel to go long as well. And sometimes we have to go down to lower time frames to look for those opportunities ourselves, but they will add. So again, trend lines, we are looking at, we either start with a high or a low, and what we look for is line of best fit, and we need more than 3 touches. 2 touches is a line, 3 or more is a trend line. So at the bottom here, we've got 1, 2, 3, 4, 5, 6, 7. We've got a great trend line here. The next one is when we draw these channels in, we need to make sure that we get a lot of clustering, support and resistance around this center line. You can see here, resistance, 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 resistance and clustering, support, support. Then you will find when you put that on one of your major pivots as well, you will get that equidistance channel, and that is the trend channel. Now you can then go down in your time frames, look for those 5th wave moves, but this again is framing your channel and looking for potentials there to look to add to positions. So again, drawing a trend channel is key. You need to practice it. The first thing is to start with where the main trend line is. And for me, we've only got this one pivot at the top. We've got a good trend line going off in there, but we need to frame the whole trend. So we need the bottom. So this is drawn first. Then when you draw your channel, you click on your next high pivot and just check before you let go that this center line is pretty spot on. And most of the time it is. You might have to adjust it slightly. So these long trend channels with small pullbacks, when we go down time frames, we can see this is the same stock on a 60-minute time frame. So there's trading opportunities within the channel on small pullbacks on that daily time frame. We go down to the 60, we find some better trading opportunities. So we've got along here, we have the double bottom. We go long through this pivot, we get a nice long move up. We've got good risk reward to the center line of the channel, okay? We get another double bottom here. We go long through this pivot. Is there enough risk reward between the low, the entry, and the center line? Yes. So on a daily time frame, we've framed the channel, the trend. We go down the time frames to the 60-minute now. Are there trading opportunities here? Yes, double bottoms, pivots, going through the pivot, enough risk reward to the center line of the channel, go long here, okay? It pulls back, we get higher support levels here with another, so these support levels down here, these support levels up here, we get a double bottom, we got to go long going through that pivot, and then we can go. So this could be a 5th wave move on a daily time frame. But if you go down to a 60-minute or a 30-minute time frame within that channel of that 5th wave move, for example, or if you're trading the 3rd wave, if that 5th wave turns into a 3rd wave and just keeps going, you're going to come down to look for opportunities to add to that position. Short-term reversals, swing pivot points, okay? So when we are trading a 5th wave move, we need to understand more behavior, what's happening. So how did the wave 3 and the wave 4 pivots behave as far as price action is concerned? We've talked about the general behavior, we've talked about the behavior on volume, but how do they behave in price action wise? I'm gonna have to keep drinking water, guys, because I'm still recovering from being ill and I'm not used to talking this much, so my voice is going. So we get, in this instance here, we get a cluster of candles at the wave 3 pivot. These are not good, no bueno, okay? This clustering around this wave 3 is not good. Remember, on that volume, we wanted to move up. We get the highest peak, we get a catalyst for a sell-off, and then we come down again. When we get clustering around the wave 4, it's still not good, okay? Because we haven't had that nice, orderly profit-taking move down, find support, and then move back up again, okay? So this is bad, yeah? So what we want is a cleaner wave 3 pivot, a clean wave 4, and then start to move away again. This clustering of price action around those pivots is not good for our 5th wave move. So again, we pull back into the red zone here. So it's still got a 75% probability of getting in that trade. Maybe our stochastic and our 535 was good. But when we look at this clustering around both pivots, this is not good for our 5th wave. It makes it an even lower probability. So it's understanding this clustering and what's going on. Nobody can really make a decision. One day here, for example, after this wave 3, we open, it goes down, it rejects those lows. The next day, we get indecision. Next day, it sells. The next day, we get this bullish army. Then we get a move up. Now we want to sell off again. Then we get a rejection of the highs. Not good enough. We want to get rejection of, you know, the lows, the highs. It's clustering. There's no real decision. There's no real profit taking. And a wave 4 is an orderly profit taking pullback. And then when we do finally get to the wave 4, before the wave 4 low, we get all of this clustering again, where we're getting bullish days, bearish days, we're getting rejections of low, which is good. But again, if we've got a risk reward, we've got to think about this cluster being resistance. So we just can't take that type of trade. So some pivots are useful, okay? This, remember how our thing where we took some barely higher highs, okay? This is a perfect example where we've had a wave 3. We did have a big rejection. We did get some more continual selling, but eventually we moved up. And the wave 4 is really important here. Slightly higher highs, running out of juice, and top of the roller coaster, and then down again. Okay. So this is a better picture. It's not perfect because the wave 3 did have that rejection, which should have started the wave 4, but there was a catalyst that did that. But actually then there was some more selling volume that came in, and then we got the high support level, then moved up. But this beautiful pivot point here on the wave 4, just imagine a roller coaster coming up here to the top, and then it's going to go down again. That is what you are looking for. Okay, bullish Arami here. Okay, we're going to talk about those in a minute. With a higher support level than this wave 3, really good. Very good looking pivot point, swing pivot point for your wave 4 there. So we've got to keep to the core patterns that will help trading the 5th, okay, with candlesticks. There's lots of candlestick patterns there, and there's lots of books out there, but the ones I'm going to talk about now, and we've been going 2 hours already, guys, but I want to finish this off. So we're going to finish this off, then take a break. So I do apologize. Talking too much. Okay, so this candlestick pattern is called a hammer. We had a rejection here at the lows, okay? Some people call it a shooting star. You know, in this case, you look at a really long wick. Basically, the long wicks mean that the price level has been rejected, okay? In this case, we opened, it dumped down, loads of people saw value there, and it was rejected straight away, and it came back up again. So that's a hammer, okay? Rejected price level. This is a piercing line, okay? Now this can happen a lot on wave 4s and wave 3. So these are, these are in and around the wave 3 and the wave 4. A lot of time they do happen on wave 4s, this piercing line again. So in this case, let's describe it. This will happen. So we gap down here on this red candle, we move down, we close near the lows. The next day, the candle opened and gapped down. People saw massive value here and bought, lots of buying going into here and closed near the highs. So this is the piercing line effect where we have this effect here, this piercing line here and here, okay? So we've got nice big full-ish bodies with this piercing line. That's a really good sign. Again, these identify reversals, okay? It's gapped down, didn't like it, loads of volume coming up. That's a good sign that that's going to reverse. The following day is really important that we get a higher high, high low on a piercing line. If we come back down again, that reversal is probably not on. Bullish engulfing. Okay, again, we get a down day. It rejects there, only rejects 50%. Then it gaps down the next day and the market says, no way, this is a buying opportunity. Boom, closes near the high. This whole candle engulfs the body of the previous candle, okay? Bearish engulfing is the opposite way around. We get a little, usually a stumpy little green candle there. The next day it gaps up and the market says, you know what, I'm taking profit here, boom. Comes down, pretty big solid candle there, engulfs that body, okay? So these identify reversals again. Good, you usually see them at wave 3s and wave 4 pivots. Bullish harami, pregnant lady, or Paul Bratby, okay? Big belly. So you get a big, long, solid-ish red candle. The next day, we gap up. The market did not, the institutional traders did not like that low. They saw volume during that pre-market, or, there was no one prepared to sell there. The brokers were having to put the price up. Who's going to buy? Who's going to buy? Boom, somebody buys there and then goes up. The bullish harami here is like a pregnant lady or a fat, bold Englishman like me, okay? Then the continuation day is really important. Morning star, again, is really, really crucial here. So what happens is a morning star is all on its own, okay? The body's all on its own. So we get a bearish day here. The next day, it gaps down, it goes down, it rejects, it goes up, it rejects, and then we get this small little body here. The next day, it gaps up and closes higher. So this little doji here is left all on its own, okay? This is a good sign to identify those reversals there, that happens. And then obviously we get that big green day. So all of these, so this is a 3 candlestick pattern here, this morning star. We get the first one here, we get the morning star, and then the next one gaps up. So this is left all on its own. That's a 3 candlestick pattern. Again, this is being recorded and we'll get those workbooks sent out to you. It has all of these big printed in there and it's a very good resource. Okay, so we're going to talk about these patterns and add volume to them now. This is really crucial, okay? Let's just go back. So here we have 2 instances that we talked about. Firstly, we've got a bullish harami. But the second part of this bullish harami has been formed with a rejection and a hammer being formed with high volume. Okay, this is important. Okay, when we get a rejection like this on a wave 4, we're not just forming a bullish harami, we're forming a hammer as well on high volume. This is an accumulation day, remember? An accumulation day, there's more buyers. There's more buy orders going in with higher volume than the previous day. It's rejected those lows. This potentially could be my wave 4 low here and need to be started thinking about an entry strategy, okay? Piercing line. Now this is important as well. This works slightly different in that we get distribution days going into the wave 4 low. The rejection and the piercing line pattern on the wave 4 is usually lower volume than these previous days. The follow-on candle is the important one here, that we get an accumulation day from that wave 4 low. So we've got the piercing line pattern, and 9 times out of 10, that rejection, that low here, and that coming back up and forming that piercing line is usually lower volume than the previous day's bearish volume, okay? The follow-on day, I'll repeat this again, the follow-on day is very important with this type of pattern. We need a higher high, higher low, and we need an accumulation day. We need more volume. So bullish engulfing. So we can see here going into this wave 4, we've got distribution days. Then we gap down and we get massive volume saying, no, thank you, good value, I'm going up. This candle engulfs this one with higher volume and accumulation day. Okay, that rejection then usually stabilizes. The following day we get more buyers coming in, but it's not accumulation day. We get less volume. We're almost back to average daily volume. So each candlestick pattern has a pattern of volume that goes with it. And these are the things I'm discussing right now on these wave 4 pullbacks. So you can understand, not only have you got the 535, the stochastic, the pullback zones, all the rules have been met, but you understand now from that candlestick pattern and the volume, how these work. This is a really good wave 4. Everything else ticks up. Good looking wave 5. It's just helping you build a more in-depth picture of that wave 4 behavior. Bullish harami. Again, this is how this normally works. You get a big distribution day here, moving the wave 4. We then gap up and we form this bullish harami, but with less volume. Then, if you remember when we talked about those fifth waves, we sometimes get that dip. The price action still goes up, higher highs, higher low, but the volume seems to peter out a little bit until we start to slightly increase there. This is important with a bullish harami. It's not like the engulfing pattern or the rejection pattern with the hammer. This is more of a break slowing down, and it takes a little longer. It's not as explosive and powerful as the engulfing on the left, but it's still a good pattern. And to be aware, when we've had that distribution day, the breaks are coming on with this harami now, okay? Then it starts to slow down, then we start to accumulate. Price action still getting higher highs, higher low, but the volume's just taking its time to catch up, okay? So this means, you know, with the harami, you need to apply the brakes a little more. So remember, behavior combines what we have just discussed. So it's not just those pullback zones, the 535, the stochastic. It's understanding the whole behavior, understanding those basic chart patterns, framing your chart with support and resistance zones, putting the channels on there where you can, understanding that wave 4 pullback, both in price action and volume. What are the predominant the candlestick patterns and the way the volume reacts with those candlestick patterns we've just discussed? Those really present a really great looking wave 4 pullback, okay? Again, we're going through this quite quick, but what we're going to do is after a 15-minute break in session 2, I'm going to answer some of your questions on what we've just discussed now, and then we'll go on to the third lesson, and then that will take us into your lunch. And then after lunch, we have one more lesson, and then we have time for more questions, okay? So what I'm going to do now is I'm going to stop this recording, because we're going to also stop this meeting, and then we're going to resume.